You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is David Smith. He's the senior analyst for the Morgan Report. You can find the Morgan Report online at silver-investor.com. Good morning, David.
Good morning, Jim. How are you today?
I'm doing great. The Olympics catching the attention of the world. I wonder what it might be doing to the world of investment.
Well, we're coming off the end of a normal summer where people are thinking more about investments. Some of us have been at it, every day because we're kind of paranoid about the markets, and also we're kind of really glued into what's going on because it's such a part of our lives. But a lot of normal people are actually out there taking vacations and doing things with their family, and now they're starting to think as we get closer to the end of August about the seasonal changes that take place in the mining stocks and the precious metals, and they tend to strengthen, and that's what we've been seeing over the last couple of weeks.
You were mentioning that when it comes to precious metals and other investments as well, how you have to keep your head in the game just like they do at the Olympics. And you're mentioning there's two kinds of investment risk that a person going into the market has to be aware of. Maybe you can mention those for us.
Exactly, and these are two critical risks, and how investors handle them and balance them out will help determine largely how successful they are in the markets or their lack of success. The first investment risk is called price risk. And when you have price risk, you have a situation where the market is really up there because it's factored in all sorts of known information and perceptions about a particular stock or about an investment, say gold and silver. And so the market, which is kind of looks ahead generally, has decided that this is the appropriate price at this time based upon what's known. And so people tend to do the opposite of what they should do in terms of their emotions. When they're confident about a particular investment, i.e. when the price is going up, they tend to want to buy. And the public in general tends to want to wait until prices have gone pretty much where they thought they would, and then they get really excited, and then they buy because they're very confident because prices are there or almost there, and that's usually the wrong thing to do. Sometimes they make money, but they make a whole lot less than they would have if they'd taken the other approach and taken a different kind of risk. And also, they oftentimes tend to buy right near the top of an intermediate price rise. Then prices decline 10, 20, 30%, and they get knocked out because they can't handle it emotionally or financially. The second kind of risk is information risk. And generally speaking, the investment you're looking at will be, quote, a low price because there's a lot of information that is not known at that time. If it's a mining stock, maybe the market doesn't know if the company's going to get a permit or if they're going to have more money for their next set of drill efforts, or whether or not they're going to, what the grades are of the precious metals that they might be finding in their drill results. And so the price language is, a lot of times it's as much from a lack of buying as it is from aggressive selling. And so again, people tend to do the opposite on this. They may have researched the company or a mining stock story or a precious metal story, and they're pretty comfortable that this is a good thing to do, but because the price is low or if it's declining, they hold off and they're afraid to do something. And so that's when you want to buy. If you've done your research and you believe that this is the right thing for you, you want to be happy that prices are declining so that you can buy some and then still buy more. And by not buying all at one time, you have a chance to buy at lower levels if it indeed goes lower. And so when we're, any of us that are in the markets, I don't care who you are, the big fish, the small fish, you have to accept these kind of risks. And ideally, if you want to try to make the most money, you have to go against the emotional herd. You need to buy when prices are declining or when they're quiet and flat, and you need to sell some when they're rising. And your position should be pretty well established before things really go up. And people just have to understand that's the way it is. If you look at some of the great investors of all time, like Jesse Livermore and Sir John Templeton and Jim Sinclair and David Morgan and John Paulson, these people have made very large amounts of money over time because they did the very things that you and I are talking about today.
So the two basic risks, information risk, do you have everything that you need to make that investment? And then price risk, you're putting your real assets on the line here. So how do you manage and balance, your information risk and your price risk?
Well, I think that balance is the key term, and you know, there's no perfect way to do it, and nobody gets it right all the time. But you look at a lot of these major investors that have made big scores over time, and people tend to think, oh, they figured out the price was going to go in a certain direction, and they jumped in, and the next day they were right. But the reality is, nobody picks the top, and nobody picks the bottom, and you don't even know that in terms of hindsight. You do, but what they do is they tend to go in layered positions. They don't put every cent they have in thinking, oh, I know exactly where I should be buying or selling in here. And they also have the strength, the psychological strength, and also the financial strength to withstand the fact that the market may go against them for a while they're putting on their positions. Some of the people that made massive profits in the real estate collapse starting in 2005 were actually putting on positions up to 2 years ahead of time. They kept buying more and more of their puts and the positions that, you know, the assumption that prices would drop, and then finally they did. And it's an art as much as a science, and you have to have that ability to stay with it. It's the same thing with buying a declining stock. I'm watching the silver stock this morning that is a royalty company stock. It's well known. It was selling for under $25 here just a couple of weeks ago. It's now knocking at $32, and there's a lot of volume, which means a lot of people are buying it. But you know, they'd hardly touch it at 25, and now they really want it at $32. So there's a classic example, and you know, right now what we're talking about of how people work, and the people that are going to make the money on that stock are the ones that bought at 25. And sure, you might make money if you buy at 32 and it goes to 40, that's fine, but just think, you've left $7 on the table because you didn't have the courage to take a position in a stock that you researched and felt was a good one.
Who makes the best risk taker?
I think that, well, you know, there's a lot of research that indicates that women are better investors than men in terms of a gender situation. They seem to approach, I think they handle risk better, and they look at perspective on things that a lot of times men don't in terms of their decision-making process. But the reality is men and women can be good investors if they if they try to balance the idea of price and information risk that we've been discussing, and if they assume that prices will go against them and account for that when they take their position, if they avoid leverage. And in this day and age, leverage is just, I don't care how big you are, leverage can take you out of the game personally. So you want to avoid margin, and you want to space out your buys and sells, and sell a little into strength and buy a little into weakness.
Do women perhaps have less ego involved when they invest? Because I know so many men, when they really get into something, they believe they know everything.
I think that's a factor, and I don't know really. I think that the word ego is a correct thing to have in there, and there's some other elements that I really can't put a name to you know, from a psychological standpoint. But they have a different emotional mix than men do, and a different intellectual mix. And I do think that ego is an important part, because they want to get it right. They don't have to be right, you know, and they don't have to prove it to anybody. So I think that that's an area that deserves further study for sure.
Well, I saw a survey, but this was done a long time ago and probably doesn't even apply to today's market, about women retiring with less money than men because they didn't take, you know, the kind of risks that men often take with investments. But I don't think being crazy and taking very risky investments nowadays is the way to go.
No, I think taking the long view and being as cautious about return of your money as you are return on the money is the way to go. And there are indications that more women nowadays are taking financial matters into their own hands and not depending upon their husbands to do all the work, because by definition, you know, if you look at the actuarial tables, women on balance tend to live 7 or 8 years longer than men. And so the odds are very good that they're going to find themselves in a position at some point in their life without that breadwinner that they had relied upon all those years. And if they've developed some skills on their own, they'll have a much better chance of continuing, you know, to earn money and to put themselves in a position financially, hopefully, where they can continue with the lifestyle that they've become accustomed to and that they'd like to carry on.
Well, I would say in today's society, the old days of, you know, dad runs all the finances is long over. You know, it's a team effort.
It really is. It really is. And with the type of decline that we've had in purchasing power, not just among Americans, but Canadians as well too, with the inflation of the money supply. I mean, for example, if I give you a $100 bill today, either as a gift or as in payment for some, service that you've rendered to me, that I could take care of that service in 1970 with a $20 bill. That's the kind of the decline in purchasing power that we've seen, and that's why I think it's so important for people to look at the precious metal story and study gold and silver and see how over 5,000 years it's been the place to be, especially in times of the turmoil like we're seeing today, because it's an insurance policy. And David Morgan talks about this. He's talked about it for many years, and he said, you look at all the paper currencies that have ever been issued, and they've all eventually declined to zero in terms of their purchasing power. So it's something that I think people should seriously study and come to conclusions on their own based upon the overwhelming amount of evidence, in spite of the difficult times that we have, or maybe because of it.
My guest has been David Smith. He's the senior analyst for the Morgan Report, which you can find online at silver-investor.com.